Good afternoon, and welcome this afternoon to Getting Started with Technical Analysis, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend James Boyd, who is a 20-plus year veteran of the financial market, even though he doesn't look it. And he is a great educator and a good friend in his own right. And I'm glad to have him on board today, helping to answer those questions in the chat. Thanks to all of you for joining, whether you're here for the first time, whether you're here all the time. We're glad to have you with us. And also whether you're here in the live version or in the recorded version. Either way, be a part of the conversation. Chat your questions in. If you're in the recorded version, leave us a comment in the comment section, and we'll get into this discussion. One of the great things to know is that you can always follow me. You can follow James and the other coaches in social media. You can follow us on X at Ben Watson CS, at James Boyd CS. James has a phenomenal X feed with tons and tons of followers. So be a part of that. Join us over there on X. We'd love to have you with us. So I have this opportunity to fill in this particular webcast today, and I wanted to, and oftentimes will do this when I have this opportunity, is answer some of the questions that come up in the various places and environments and forums in which I teach. One of those is our live trading environment. And so as I teach technical analysis, and as we do it in webcasts and in the live environment as well, one of the questions that oftentimes comes up is, yeah, but isn't technical analysis just seeing things that maybe don't exist, or drawing lines that don't really mean anything because they can't predict the future? And the answer to that question is, yeah, technical analysis can't predict the future because news changes everything. And yeah, technical analysis to a certain degree is based on what has happened and simply drawing lines and finding price movement. And the next follow-up question is, well, wait a second, this isn't the way that the market works. We're just trying to best fit something into a framework. And my answer to that is, yeah, we are. We're trying to best fit what price is doing in a random, chaotic situation into some kind of order, into trends. So we're going to talk a little bit about this idea of technical analysis and trend and best fitting what we see happening and putting our own kind of mathematical and visual analysis to the discussion. So we're going to talk a little bit about this idea. It is often maligned, and there's a lot of mythology about it, but the idea of linear regression, we'll talk about what it is and maybe what it isn't, or maybe what it shouldn't necessarily be as we get into this discussion. But a couple of quick housekeeping items before we get into the topic today. Remember that everything we talk about simply for illustrative and educational purposes only, is not a recommendation of a particular strategy or account type or type of analysis or particular technical indicator or anything else. If we talk about options in this discussion, it's important to remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. Now, there are many, many ways to look at the market. Technical analysis is only one of them. But technical analysis, fundamental analysis, probability analysis, all are theoretical in nature. None of those are guarantees as to what the market is going to do. And therefore, Schwab doesn't recommend the use of technical analysis or any other sole means as an individual and only means of investment research. We're going to be using the Thinkorswim desktop software platform today, specifically the Paper Money platform. Not a guarantee future success, great sandbox to learn in, but it doesn't do certain things that a live trading account will do. It doesn't use studies in it, scans, those types of things. One of the biggest issues, or one of the biggest differences, if you will, is that in a Paper Money account, the fill prices on orders are going to be a little bit different. Typically, those are going to be algorithmically derived fill points, typically coming from the midpoint between the bid and the ask. Whereas in a live trading environment, the fill price of an order, whether a buy order, sell order, entry or exit order, doesn't matter, is going to be derived from market forces at work. So as you move your practice from paper trading to live trading, understand some of those differences. Investing involves risk, including loss of principal. Past performance, no guarantee future results. Stop orders don't guarantee the price at which that order is going to get filled. So just be aware of that as we get into this discussion. So a couple of quick ideas. We're going to talk through technical analysis, specifically linear regression. We'll talk about some strategies around that, and then we'll look at some examples on the chart. But looking at examples on the chart is the way that we're going to discuss this. So here is the trend of Walmart. This is a 1-year daily chart of Walmart, and it's relatively chaotic. It's also at the same time relatively ordered. So there's a couple of different ways that we could view trend as we look at a chart like this, and a chart where we've seen a change in that trend, at least in the short term. So we can count highs and lows, and there are tools that are available to allow us to do that. And matter of fact, James, in his investing masterclass and his trading the trend class webcast, talks a lot about some of those tools, highs and lows, counting the highs and lows, looking at the duration of those highs and lows. That's a certainly very acceptable and very common method for approaching determining a trend. Another method might be using a moving average, for instance. In fact, I'll just put it on here, a typical moving average, right? This is the 200 period moving average, and you can see the trend direction here defined by this mathematically derived, not necessarily imperfect, but not necessarily perfect moving average. It's just simply a mathematical description of what the closing prices have been for the last 200 bars or displays of information on this chart, and then calculating the average of those. Now, there are other ways to mathematically manipulate this moving average. I know James talks about on his investing masterships, he talks about using a mathematically manipulated moving average called the Hull moving average, which is simply another way to view this mathematical relationship of price movement and get a definition of what trend is doing. So, like I said, there's many different ways to go about doing this, to define what a trend is and what a trend direction is. None of those are perfect, right? There is no one best moving average. There's no one best technical indicator. All of them have different characteristics that fit different circumstances. But that common indite of saying, well, yeah, you're just kind of best fitting what you see into what's happening. And the answer to that, I think, in my mind, is yeah, there is a way to kind of best fit what's happening. And one of them is using a statistical definition of what this trend line is. And statistics, as we know, are just simply a mathematical way of expressing something happening, right? Whether we're talking about option price movement or probability, whether we're talking about temperatures on a meteorological chart, something like that. Statistics is simply a way of defining what's happening mathematically. So we're going to use a tool. I'm going to introduce you to a tool today in terms of linear regression that maybe helps to kind of put some order to a little bit of this chaos. Grant, we have lots of different webcasts that talk about that. That is not my topic of discussion today. However, we have lots of those, and I'll show you some of those resources when we get into that section of this discussion in terms of resources. But there are those out there. In fact, we teach a couple of different webcasts throughout the week, trading flag patterns, trading price patterns, that all focus on some of those things, ascending and descending triangles for sure. And this chart has some of those along the way. But the tool that I'm going to talk about today, we're going to use, is one of the linear regression tools that's available in the Thinkorswim platform. So I'm going to come over here to the left-hand side of my Flask icon, Edit Studies and Strategies discussion. And I'm going to pop in here the word linear, L-I-N-E-A-R. So right in the word, the first definition of the word, you've got linear, line. We're going to create a line here. And so we're gonna look at this idea of a line by simply taking this first one, or the one in the middle of this linear regression. These are all the linear regression tools in the Thinkorswim pre-built set of tools. We're going to take the linear regression trend line. So what I'm going to do is I'm going to open up this little question mark I do, this tooltip. And it says that the linear regression trend line study plots the trend line of price for the entire span of the chart that we're looking at based on the linear regression analysis. This line is derived by approximating all of the past prices within that time frame using the least squares method, which is a way of determining statistical ranges and standard deviations. So a linear regression line, or a linear regression trend line, and I'm going to put this linear regression trend line on here. The definition of this line, as we look at this, is, so we're going to use closing prices. I'm going to make this a little bit bigger so that we can see it. This line is a line that takes the entire scope of data that's presented on this chart, all of that chaotic price movement up and down, and it factors it into a one standard deviation range, and then it fits a line right in the middle, best fit of that one standard deviation range. Okay, this is the linear regression line or trend line. So we're going to apply this on the chart. And so what that line does, and you can kind of see that line moving, is it is approximating, best fitting, if you will, that trend line as the price of the stock continues to move. So for those traders or investors who are brand new to technical analysis, brand new to trend identification, what I've found is that this tool, linear regression trend line, is one of the best tools, and it is not the best tool, it is a best tool for helping a trader to identify what is the direction of the trend over a particular time frame. This is a 1-year daily chart. If we were to change our time frame to a 3-year weekly, we can see that trend curving, but we can see what that trend is doing, and objectively, we can see, are we above or below that trend line? By the way, this can even be used on a shorter term basis, because it's going to take mathematically whatever amount of data is available in that time frame of the chart. So we could go to, say, a 5-day, 5-minute chart. And we can say, what's the trend of the stock over the last 5 days using 5-minute bars? What's the trend of the stock? It's in a short-term downtrend. Right? We can see that objectively. We can see that we're slightly above that trend line on that short-term time frame, but as opposed to the chart that we were looking at before, the 1-year daily chart, which is a strong uptrend, right now we're in a short-term downtrend. We can see that, we on this last earnings announcement, we saw a big gap to the downside, and we're seeing some downward movement. I chose this stock specifically for this purpose because it presents that interesting conundrum for a lot of new investors to just get anchored to the last few days of price movement in terms of determining the trend. Well, gosh, it's gone down the last 3 days, therefore it must be in a downtrend. So using linear regression and using this linear regression line can be a helpful tool in helping us to kind of settle our approach to evaluating a trend. So I wanted to come up with kind of a metaphor, if you will, to understand the way that this works. And so the metaphor that I came up with is, and we happened to be out of town over the weekend, and we were in a park at a farmer's market. And I happened to watch somebody walking down this long, straight sidewalk. And they had a new puppy with them, and the puppy was on a leash. And the puppy was all over the place, right? As a puppy is wont to do. It moved to one edge, the other edge, it moved, stopped and sniffed and stuff. Kind of came back a little bit and then went to the other edge, and it was fairly random and chaotic in terms of that movement. And it, moved left and right within the general overall direction that the person was moving. The person had the puppy on the leash. So the puppy could move in a relatively well-defined range. The definition of that range was the extent of the length of that leash. So the length of the leash here, if you want to think about kind of this metaphor, the puppy's price movement, the sidewalk is this linear regression line, and the leash represents one standard deviation, or the standard deviation range of price movement. So when price gets out to that statistically derived range, it's an indication that it is likely probability based likelihood of it moving back towards the center. Now, can it move outside that range? Yes. And if it continues to do that, that's going to move the linear regression line. So it's not an absolute. The puppy could, I suppose, run hard enough and fast enough that it would break the leash or yank the leash out of its owner's hand and move outside of that range. But and that can happen with news, right? So here we have Walmart kind of walking along the sidewalk. News comes along, price breaks down. It's the puppy moving substantially quickly in one particular direction. But nevertheless, we know the direction that the sidewalk is taking. We know the direction that the owner is walking. The puppy's just moving. Price action is moving within that particular range. So now that we've got the definition of that linear regression line, we kind of have an understanding of how it works, not going into the math per se, but just understanding how it gets visually displayed on the chart. We can see that Walmart is well below that one standard deviation line. So for some investors, it may just stop right here. This may just be the end of their incorporation of linear regression into the discussion, to be able to say, look, I'm willing to get out of the trade because price has made a big move below that linear regression line, and it's not as bullish as it was before in the short term. And some traders might look at this and say, fine, you know what? I'm going to look at entering this trade when price moves back above that linear regression line. So they might use it for both entry and exit orders, or entry and exit decision making. Nothing about this predicts what the price of the stock is going to do next. In fact, nothing can predict precisely what the price of the stock is going to do next. I don't know if tomorrow's candlestick for Walmart is going to be lower or if it's going to be higher, because I don't know what the news is going to be that's going to drive that price movement. I have a probabilistic approach, an idea of where it's likely to be, but that's still not a guarantee. And that's what makes this an imperfect system, because news changes everything. News cannot be, by definition, predicted. Now, there might be some statistical boundaries of where it's more likely for news to change price movement, but and within what range. But there's I suppose could be news that is either significantly good enough or significantly bad enough that it could push that price movement outside of that range. So now let's talk a little bit about this range idea. There are tools that allow us to build kind of this range into the mix, right? If we're using kind of that center regression line as our center moving support and resistance level, that kind of center line hub, if you will, that's one thing. But now defining that range, there's a couple of different ways that we can do that. So what I'm going to do now is I'm going to keep that line in place. I'm going to keep this linear regression line in place, and I'm going to add another linear regression tool to the mix. So what I'm going to do is I'm going to come back up to this flask icon up here at the top. And I'm going to type in the word again, L-I-N-E-A-R, linear regression. Okay. So the next tool that I'm going to use is I'm going to say, fine, I want to define the range that this puppy has walked over the course of the time frame of this particular chart. I want to be able to find the highest price and the lowest price that this stock price has moved, and then define a range around that. So I'm going to use the linear regression channel tool, and I'm going to click on that little question mark icon again. So this visualizes general price trend of the entire chart, again using linear regression. First one is the linear regression trend line of the price. The other two are lines that are equidistant, plotted above and below. The distance at which those are at the extremes. So what we're doing now is we're defining extremes. So I'm going to click on linear regression channel, double click, and I'm going to put that linear regression channel on this chart. I'm keeping the linear regression trend line, so we're going to be a little bit redundant here because it's going to incorporate a linear regression line as well in that channel. But I'm going to use the linear regression trend line that we already drew so that we have an anchor, and then the linear regression channel. And this is 100%. So we're taking the maximum extremes, top and bottom, high and low, outside that line to the upside, outside that line to the downside. And click on apply and OK. And so the time frame that I'm looking at here is still 1 year, right? Still 1 year. So all I'm really doing is, and again, this is using closing prices, which is why you might see wicks or shadows of those candlesticks bleeding outside that linear regression line, because this is using closing prices. So the highest closing price that we've had is up here. The lowest closing price, or at least where we are right now over this time frame, is right down here. And it's equidistant in terms of that movement, that range. So we've defined the width of the path that the puppy has moved in, left and right, or up and down from that center line, if you will, the linear regression line. So again, we can objectively say this. We can say, look, here's the center point. We're best fitting that line to price movement. This is the standard range. This is that statistically defined trend line, if you will. And we can argue that, wow, we're down in that lower portion of the range. We're kind of at that extreme that this price has been moving in. We're at the lowest point, or the furthest point away from that line to the downside that we've seen, right? So we could say, wow, this has not gone lower than this because this is the low so far. And that means that there is a statistical probability that price bounces and goes higher from here. So this trend line, so we've got two studies on this chart, Amanda. We've got the linear regression trend line, and we've got the linear regression channel. Those are the two lines that we've got on this particular chart, or the two studies that we've got on this particular chart. The lines out here, that's the linear regression channel, highs and lows, the extreme range, the 100% representing that distance. Now, from a decision-making standpoint, we could say, fine, if price breaks out of this range, then that's something that I wanted to take action on, right? If we're breaking below this low. So a trader who is in this position, running this study, the linear regression channel, says price is down near that lower portion of the channel line. I'm going to come in here and I'm going to draw a line that says if price breaks outside or below that range, then take action, like sell the stock. Else wait. And if it doesn't, if it bounces and moves higher, the trader is still in the position. If a trader were to see that the price of the stock were up here at the top edge of that range, they might say, well, you know what? Maybe that's a time to perhaps put a limit order on to get out of the trade if it continues to move up, or because it's likely to pull back from that level, or use some kind of income generating strategy like for instance, covered call as a possibility, or look at the possibility of peeling back some of that position, maybe taking some of the position off. So Michelle asks the question, why would you use this over a Bollinger Band? Because the Bollinger Band is based on implied volatility derived, which is supply and demand. There you're adding a human element to it. Implied volatility based range of price movement. This is purely statistical. This is taking what price has done. Now, granted, that's still human derived, but Michelle, this is, I think, a little bit simpler. It gets us to Bollinger Bands for sure. But it gives us kind of that first definition. Now, I'm not advocating for one strategy versus another, because I've always said, and you've heard me maintain this premise, that there is no one best technical indicator. This is simply another way to use the technical indicators that we have in understanding the importance of those influences. So something that a trader could do now is subset or subdivide this range. There we go, Paul. You got it. You are a step ahead. So here's what a trader could do in terms of kind of gauging. And I like this because this works very, very, I think, complementary to some of the things that James Boyd teaches in his Investing Master series, where he talks about the phase or the season, for instance, that a stock price might be in. And this is another way to kind of think about that. So I'm going to put on here, go to my Flask icon one more time. I'm going to come over here, type in the word linear, L-I-N-E-A-R, linear. And I'm going to choose a linear regression curve or linear regression channel 50%. So what I'm going to do, this is the linear regression channel 50% is similar to linear regression 100. The only difference that upper and lower lines are placed at a distance equal to half of that range. So we're just going to subdivide this channel from the extremes into half of the extreme, if that makes sense. So I'm going to add the linear regression channel 50. But what I'm going to do is I'm going to come over here to the little gear icon and I'm going to change the color. We're going to make sure that we've got a different color here that we're displaying. So there's our middle line, and those are all blue. I'm going to make that a little bit wider so that we can see it 3 points wide, just so that it's a little clearer on the chart. Again, it's going to be based on the closing prices, but you can change that as well. You can do, this linear regression tool on volume if you want. That's again, an appropriate statistical use of this particular tool. Now, those blue lines that you see, Greg, thank you very much. I appreciate that. Paul, the blue lines that we see on this particular chart represent the linear regression 50, or linear regression channel 50 study. So going along with, say, for instance, James Boyd's seasonality approach, which I love that approach. It's a great discussion. By the way, James, I think, has put some links out there into some of the webcasts that he teaches. So we could maybe make this argument. I'm going to kill this line right there. I'm going to just remove that trend line that I drew. And I'm going to grab my magic marker tool here really quick. So this range right here, if this is our extreme, right, then we're by necessity below that 50% range. Then we've got our linear regression line. Then we've got 50% to the upside. And then we've got 100% to the upside. So we might label it thus. We might say this is plus 100, right? Plus 100. This is plus 50%. This is 0, or our starting point, our origin, that central hub of the linear regression line. This is minus 50%, and this is minus 100%. Okay? So that's kind of the way that we might look at this. So we can say, wow, we're down at the bottom of that range. This isn't a really, well, we could say winter hasn't only just been coming, winter is here. We're down at the bottom of that linear regression line and that linear regression channel. When we were up here, right? When we were up here, we were in full-on summertime, baby. And we were at that 100% of that range. We were at that extreme. But we were at summertime going into fall, or maybe spring, depending on which direction we were headed. I don't know. The metaphor breaks down at some point. But what this allows us to do is make a decision. And again, we can use this as a decision-making tool. So for a trader looking to get back into a trade or looking to get into a new trade in a situation like this, where price has gone to an extreme and it has a statistical probability of moving back to the upside, that linear regression channel could be an entry tool to say, fine, if price breaks above this level, then enter the trade, else wait. And maybe it is if price breaks above that 50% minus linear regression channel, then enter half of the position and then enter the rest of the position when that price moves above the linear regression trend line. So that's an important consideration in terms of using a tool like this that is statistically derived. It's simply giving us a mathematical way to order our decision making. Because many times, the questions that I get from new investors and from investors that have maybe been looking at technical analysis for a long time, or maybe you're brand new to it and saying, well, I still don't know when to get into a trade and when to get out of a trade. So this is just another way to look at that, right? To look at that approach. When do I get into a trade? When it's giving us some confidence that it's moving in a particular direction. So if it's moved outside of that linear regression channel and now it's moving back inside of the linear regression channel, that might be a decision-making point, right? So Lakshmi asks the question, 3-year weekly versus 1 year, 1 day, when the time frame for Walmart or for any stock? Depends on your length of time. So if you are a longer term investor, you might put this linear regression tool on a 3-year weekly chart or a 5-year weekly chart. If you're an intermediate term trend trader or even a long-term trend trader, you might use a 1-year daily chart. If you are a short-term trader, let's do this. If you are a short-term trader, let's do clear all drawings. There we go. If you're a short-term trader, you might do this on, say, for instance, a 5-day, 5-minute, or some other type of chart and say, all right, cool. I'm in a downtrend short term, but I'm moving back up above this range. And you might say, fine, you know what? If it's staying above this level, or maybe I get into the trade on a trend change point when it moves above that upper linear regression line, or maybe that 50% linear regression line, that might be your entry point into. So user asks the question, yes, I just changed my time frame. We're now down on a 5-day, 5-minute chart. So now Michelle's starting to think about it. Now you're starting to think through this. What else could we use as a confirmation? RSI, MACD, stochastics. Yeah, all of those oscillating indicators could be used as a confirming factor for this tool. Let's go back to that 1-year chart and let's kind of walk through that again real quick. 1-year daily chart. Now we're down on that lower line. Let's put on here something just very simple, straightforward. I'm going to put on here the RSI. Again, there are lots of different ways that you could evaluate trend strength. RSI, Relative Strength Index, is simply one of them. I'm going to use a standard box stock out of the box linear regression or a Relative Strength Index, RSI. RSI is down in the lower portion of its range. You can see that RSI has now moved to a new lower low. So a trader looking to get into a trade could look for confirmation. So this might be our confirmation. And let's kind of phrase this as an if this, then that statement. If price moves back up above the 50% linear regression channel line on the downside, and RSI is making a new high or is turning and then pointing in an upward direction, whatever you want to define as that indicator giving you confirmation, then enter the trade, else wait. But if RSI is still moving down and the price is not breaking back up above that linear regression line, don't get into the trade. So you can use this in combination with any kind of stochastic indicator, any kind of MACD indicator. Let's pop MACD on here real quick just to kind of confirm that. So we take the linear or RSI off and we put on here MACD again, box stock MACD, and say if I've got positive MACD, and price is above that linear regression line, then I'm going to enter the trade. All right. Simply another way to be able to make an entry decision. Buy, sell, or re-enter. Absolutely. Now, I like Emmanuel's question, which is, can linear regression lines be used with Fibonacci numbers? Yeah, that's an interesting concept too. Let's do that really quick. I'm going to hide that MACD really quick so that we've got that in place. And I'm going to use a Fibonacci retracement here. I'm going to actually go for a longer term move. I'm going to take this big move that the stock made from this level of support back here. So I'm going to grab my Fibonacci retracement lines, right? And I'm going to go from here where that support level was up to this level right here. So I'm drawing from the bottom to the top just so that we can kind of see that. Wow, that's really interesting. Because look at where that move is coming to, right about the 50% level on that Fibonacci line. Now, to be fair, 50% is not technically a Fibonacci level, but it is certainly a Dow theory level. So, that's something that could be used. You can use Fibonacci's in context with this linear regression line. I'm going to remove that. So experiment with that, play with that. Now, One Morning Rush says, can we use the linear regression on intraday or more of a long? Yeah, absolutely. Let's take a look at another example. And I had another example here that I wanted to look at, and that was one that was making a little bit more of a breakout. AMD, I think, was the one that was making a breakout here. So I've got a bunch of lines on there. So notice what happened here. We had this strong move to the upside, a little bit of a pullback, and now we've got this move to the outside. Now, here's the thing. Because remember, that's the range that the puppy has gone, and this is the absolute. That's the farthest away from that middle point that the puppy has gone over the course of this time frame, right? Going back to our metaphor. So we're right kind of out at that extreme, but that 50% level is simply half of that. So where did we get that bounce? About half of that extreme move. So that could again justify or talk about the idea of giving confirmation to a breakout type of move by saying, look, that was the extreme, draw a line, a break above that level could give us that extreme point. Now, I'm going to change my time frame once again to intraday to go back to One Morning Rush's question. Let's go down to, say, for instance, let's go to a 1 day, 1 minute. So if you're looking for an entry into the trade to give some confirmation to that short-term breakout move, we're right at that upper portion of that 50% line. So a trader could use this and say, if price breaks above that 50% linear regression line on the short term or intraday chart, then enter the trade. So I'm going to just structure our entry that way. Right click, buy custom. Actually, I'm just going to do buy, and I'm going to do a buy stop because that linear regression line is at 50.68. So I'm going to right click and buy, but I'm going to edit this, and I'm going to do that as a buy stop. 50.68 is our entry here. So I'm going to make that stop. Wait. Don't do anything until the price of the stock gets to 50.68, then enter the trade. 50.68 would be breaking that 50% linear regression channel line, and we're going to put that in I'm going to put that in my workshop group there. Click on send and fire that order off, and we're right there. And I did that as, you know what I did? Anybody catch what I did? I'm going to do that again. Right click, buy, edit. We're going to make that a buy stop because I did that as a limit order. So we're going to do the same thing. 50, 68, 560.68 there. And we're going to do that as the correct way to approach that trade, which is a buy stop. Click on confirm and send, put that in our Boston group, click on send. Now we're sitting there as a buy stop. I did it as a limit order. That's always a good idea to read your order, guys. So one last tool I'm going to show you, and then I'm going to wrap this up and give you some resources. Okay, one last tool. We're going to pop back out here to our 1 year daily chart. And one of the things that I happen to notice about this, and I'm going to make this a clear drawing set. Let's take that to a clean drawing set. Let's go back and move those lines off of here, is you can see how wide this range is and how far that's moved. So what I'm going to do is I'm going to put one additional tool on this particular chart, and that is the linear regression slope. Okay, the linear regression slope gives us an indication of a momentum shift. So when we see the linear regression slope indicator moving above zero, upward momentum is increasing. When it's going below zero, downward momentum is increasing. Kind of, again, that confirmation that we use from RSI or MACD. I'm going to go to my Flask icon, LIN, linear regression slope. And if I do my tooltip, linear regression slope displays expected price change based on linear regression analysis, least squares. High positive values indicate a buying opportunity, low negative values signal the seller should open a short position. Again, that's not me, that's simply a technical analysis approach to looking at this. So I'm going to add that linear regression slope to this chart. I'm going to click on apply and OK. So what this says is that what's going on right now, and again, this is going to lag a little bit because this has got a 14-period look back. We can adjust that. That's going to incorporate that last little bit of pullback that we saw here. What that says is momentum is falling off a little bit, starting to move lower. But this might also be a confirmation tool. When price is moving up and that linear regression slope is positive, then enter the trade or exit the trade when price breaks through a level of support and that linear regression slope is negative. Again, another additional tool that we can add to this mix. So simply using that idea of best fitting the statistical reality into a chaotic system, we've learned how to define the trend direction and the extremes, and then subdivide those extremes to get a better idea of what the price of the stock is doing at any particular time. And now we've added into that mix that momentum change, if you will, using that linear regression slope tool. A couple of weeks ago, I taught a webcast talking about that linear regression slope. I'm going to pop back over here to the Trader Talks webcasts page. Linear regression. I think I put it in the title. Linear regression slope. James has done that. He did that last year. I'm going to just type in, I'm going to take this back and I'm going to say linear regression. Cameron's taught it. I taught it. Emotion versus statistics using linear regression. I taught that in Trading the Trend. So a couple of great resources. If you're brand new to technical analysis, this is a good place to get started. Just in typing in the topic that you want to talk about, or type this in, getting started with technical, and you're going to get to the playlist for getting started with technical analysis. That playlist is right here. You'll see all of those webcasts. All we ask is that you click on that subscribe button right there so that it's easier for you to find these webcasts. It's easier for other people to find those webcasts. Great way to kind of have your own personal archive of webcasts and topics that's searchable. Good stuff to be able to continue to learn more about technical analysis. My thanks to James Boyd for helping out. My thanks to our great production staff and our reviewers, and the opportunity to fill in today for Armstrong in doing this technical and getting started with technical analysis webcast. Guys, give us a follow out there on X and on LinkedIn at Ben Watson CS, at James Boyd CS. Have a great day, everybody. We'll see you again very soon. Take care. Bye-bye.